All right, let's get right into it. Today, we're unpacking a really eye-opening analysis of Canada Revenue Agency audits targeting tax-free savings accounts, our TFSAs. Look, a lot of us just assume a TFSA is this unconditionally safe vault for our money, right? Well, as we're going to see from the source material today, that is a wildly dangerous misconception. We're going to dive into the hard data, some wild case studies, and the exact, down-to-the-letter rules catching thousands of Canadians completely off guard.
Okay, let's kick things off with a massive number, $166 million. According to the analysis, that is a total amount in fines slapped on 133,300 Canadians by the CRA in 2024 alone, just for TFSA violations. I mean, that's a staggering figure for an account that literally has the words tax-free right in its name.
And it's not just a one-off year either. This shows the escalating danger perfectly. Check out this stark jump in penalties. CRA audits surged from $130 million in 2023 up to that $166 million in 2024. That is an increase of over 27% in literally just 1 year. The CRA is clearly ramping up its oversight, proving that having a TFSA definitely requires some careful navigation.
So here's how we're going to systematically uncover the 4 massive pitfalls outlined in the source material. 1. The $166 million CRA shock. 2. Trap 1. Day trading. 3. Trap 2. Over-contributing. 4. Trap 3. Non-resident status. 5. Trap 4. Advantage rule. And finally, 6. Protecting your tax-free account. Section 1. The $1,666 million CRA shock. The illusion of safety.
Now, the core logic behind the TFSA, which came out back in 2009, is incredibly simple. You put in after-tax money, and any investment growth, dividends, or capital gains inside the account completely tax-free. And when you withdraw it, it doesn't count as income. Now, the contribution limit for 2026 is $7,000, and if you've been eligible since day one but never put a dime in, your lifetime maximum sits at $109,000. Sounds like the perfect financial tool, right? But here's the catch the source highlights. That incredible flexibility is exactly where the severe CRA monitoring kicks in. You're trusted to manage it yourself, but believe me, you are being watched very closely.
Section 2. Trap 1. Day trading. When success becomes a liability.
This real-life horror story perfectly demonstrates the danger here. Let's look at Fareed Ahmed. Starting in 2009, he aggressively traded penny stocks in his TFSA, sometimes holding them for literally just a few hours. Well, through these rapid-fire trades, he managed to turn $11,500 into over $617,000. Amazing, right? Not exactly. Because massive, rapid TFSA growth isn't always rewarded, it actually triggers immediate CRA scrutiny. The CRA stepped in, took one look, and declared Fareed wasn't investing. He was running a trading business. And just like that, the entire $617,000 was reclassified as taxable business income.
Ouch. So what's really interesting here is how clearly the source defines the CRA's unwritten criteria. See, the CRA doesn't give you a strict maximum trades per month rule. Instead, they look at your behavior. Are you an investor holding long-term assets like ETFs or blue-chip stocks? Or are you a trader? They're looking at transaction frequency. Are you trading daily, weekly? They look at holding time, years versus hours. They look at whether you're borrowing money to trade on margin inside the account. And crucially, and this was exactly the case with Fareed, they look at your professional background. If you work in finance, the CRA is far more likely to view your aggressive trading as a literal business operation.
Section 3. Trap 2. Over-contributing. The 1% monthly penalty.
Okay, this jaw-dropping number comes from a 2020 court case highlighted in the source material. A taxpayer over-contributed nearly $640,000 into their TFSA. And this wasn't just some tiny rounding error. They actually borrowed the money from a line of credit and just dumped it all in. Well, the CRA hit them with a strict 1% monthly penalty on that over-contributed amount. The taxpayer tried to fight it in court, arguing they didn't really understand the rules and, hey, the market had tanked anyway. The judge's ruling? The CRA won. The court made it crystal clear that taxpayers bear complete personal responsibility for tracking their own contribution limits, period.
So the absolutely crucial point here is following these exact steps to avoid accidental overcontributions, especially when you're moving money around. If you want to move your TFSA from Bank A to Bank B, you absolutely must request a formal direct transfer. Yes, you might have to pay a minor $50 to $150 transfer fee, though some banks will actually reimburse you for that. But whatever you do, do not just withdraw the cash from Bank A and manually deposit it into Bank B yourself. Because if you withdraw funds from a TFSA, that contribution room does not reset until January 1st of the following year. If you manually redeposit it in the same calendar year, the CRA views it as a brand new contribution. And if you're already at your limit, boom, instant overcontribution audit.
Section 4, Trap 3, Non-Resident Status, the expat's blind spot.
Now, the core rule here is absolute. If your tax residency changes from Canada to another country, you've got to immediately stop depositing funds into your TFSA. A lot of people just assume that because they have a Canadian passport or permanent residency, they can keep using the account like normal. But if you live abroad for more than 183 days a year and lose that tax residency status, every single dollar you deposit into your TFSA will get hit with that 1% monthly penalty. The source actually points out this is incredibly common among people who relocate for work but have family manage their accounts back home. The silver lining here, the assets that were already inside the TFSA before you left can stay there and keep growing tax-free. You just literally cannot add any new money.
Section 5, Trap 4, Advantage Rule, the climax of complexity.
The TFSA Advantage Rule. This regulation is basically designed to catch people who try to get a little too clever. The CRA's logic here is super strict. Any attempt to unfairly boost your TFSA returns using inside advantages crosses the boundary of legal tax optimization and becomes an illegal advantage. You just cannot use special backdoor arrangements to guarantee massive, risk-free growth inside a tax-free shelter.
And if you trigger this advantage rule, the punishment is downright draconian. The CRA doesn't just tax the specific transaction that broke the rules. No, they seize 100% of the account's total growth generated from that advantage for that year. Every single cent of profit tied to that unfair advantage is taxed at exactly 100%. Let's break down exactly what the CRA considers an unfair advantage, which honestly, a lot of investors mistakenly believe is just smart financial planning. First up, personal investments. Say you work for a private company and you get to buy company stock at a really steep discount. Well, if you facilitate that discounted purchase inside your TFSA, the CRA sees you using your employment advantage to artificially inflate your tax-free account. Second, swap transactions. This one is highly technical but surprisingly common. You've got a stock in a regular taxable account that's about to explode in value. You swap it with cash sitting in your TFSA to ensure all that future growth is tax-free. Yeah, the CRA explicitly banned this back in 2011. Doing it triggers that 100% penalty. And third, non-arm's length transactions. This is when, say, a spouse's private business pays out massive, disproportionate dividends directly into your TFSA, avoiding normal corporate and personal taxes altogether. The CRA definitely considers this an unfair advantage.
Section 6, Protecting your tax-free account, Taking Control.
This quote is a stark reality check provided right in the source. You might be thinking to yourself, hey, I'll just check my contribution room on the CRA's My Account portal. But you really need to be careful. In early 2025, and historically, honestly, data processing delays meant the CRA's own portal displayed incorrect, outdated contribution limits. Financial advisors have actually lobbied for exemptions for people who overcontributed based on the CRA's faulty data. And the CRA's official response, data inaccuracy does not constitute grounds for exemption. Think about that. Even if their own system is totally wrong, you are held 100% liable. You have to track your own deposits and withdrawals manually, like on a spreadsheet, to be truly safe.
And that brings us to the ultimate question you need to ask yourself today. Are you treating your TFSA like the long-term safe deposit box it was originally designed to be? Or are you accidentally treating it like a high-risk trading floor? Based on the detailed analysis we've explored today, protecting your wealth means auditing your own behavior right now. Track your limits manually, steer clear of aggressive short-term trading, make absolutely sure your tax residency legally matches your deposits, and for sure, avoid those complex backdoor advantage setups, because the rules are definitely not going to bend just because you didn't know them. Thanks so much for joining me on this explainer, and I really hope this helps you keep your tax-free money exactly that, tax-free.